Hello and welcome to BQ Prime, and we are in conversation today with Mr. R. Shankar Raman, Group CFO at Larsen & Toubro. Mr. Shankar Raman, thank you very much for joining us on BQ Prime. Uh, you know, the earnings came in last week, but let's concentrate on what is the macroeconomic environment today, and then from there we take it forward how L&T is placed in this macroeconomic environment. How do you see the entire cost and the inflationary pressure which you've been seeing for the last 2 quarters? Is it ebbing or do you see sustained going forward?
I think we are in an interesting spot. We have seen tough times led by COVID. In fact, even leading up to COVID, the economy was not as strong as it ought to be. And then COVID came and disrupted a lot of things, and in two waves, both in 20 and in 21. And in 22, we have the war. So I think the last 3 years have been very eventful on a global platform. But having said that, I think India's resilience has been pretty surprising. In fact, the government was very prudent in trying to direct relief to sections of society which badly required them. So we didn't go out of control. The balance sheets of the government was pretty well managed. Consequently, the last 1 year or so, we've been able to see allocation of capital towards projects which are important from an infrastructure point of view, and that plays to L&T strengths actually, because any allocation to infrastructure, and particularly if there are large programs like the ones that we are currently executing, then it is of considerable interest and economic benefit to L&T. The period of these last 2 years, thanks to the disruption in the supply chain and also the war, has led to some severe spikes in prices of some of the key inputs that we import into the country, as well as broken down supply chain, because the traditional sources of supply weren't able to cope up with the demand, and they had to respond to their local economic environment. So consequently, we had to, like many in the industry, had to realign the supply chain, go to alternate sources, establish the same comfort that we had established with the original supply chain, etc. So in this period, both delays in supplies and ordering, obviously, as well as the price points having got elevated, did cause stress from an input cost point of view. Fortunately for us, in our contracts, two-thirds of the contract have some form of price variations built into them. These are through formulas that we have pre-agreed with the client, etc. So even if I take the timing mismatch between the period I incur the cost and the period that I get reimbursed, even if I take that in my stride, the contract structure provides for some element of pass-through. So we have been able to manage the significant disruption in input availability and cost by containing the damage to about 80 basis points last year. That is in FY22, we actually reported 80 basis points lower than what we were targeting to report. And in the current year, for FY22-23, based on the margins of 9.2% that we reported last year, we had guided a 9.5% margin, a 30 basis points improvement. And in this process, we factored some improvement in both the availability and the working of the supply chain, as well as some cooling of the inputs. True to expectation, I think the prices have fallen off their peaks. Steel, copper, aluminum, they've all come off the peaks that they have been. They're still high, but they're not as hurting as they were, let's say, 1 year before. Oil has also stabilized, so consequently the energy prices have stabilized. So we are now entering into a period where the prices could be stable and maybe trending down a bit as demand corrects itself. The tightening of the interest rates by all monetary authorities is going to have an impact on the global demand. There are pockets of economies which are contemplating recession, Some are on the milder side, some are on the severe side. All of this is expected to have some sobering effect on the demand. And hence, I do expect going forward next 6 to 12 months, the commodity prices to be more affordable than what they are. The benefit of this will flow to us maybe 6 to 12 months going forward, because currently we are consuming commodities that we contracted at a higher price last year. And now, whatever we contract will actually flow into our profit and loss account through revenues in the following year. So I expect 23, 24 to be a kinder year in terms of impact of input cost, and hence I do expect margins to move up from here. The quantum of that movement maybe as we close this current year, and when we talk to the streets about our annual performance, we'll possibly give some guidance about how the margins could play out in the following.
How do you see Capex cycle picking up? Because you said it's seen some kind of improvement, but can you give me a breakup of this entire Capex cycle between central Capex, state Capex, and private sector?
Yeah, I think when we look at the overall Capex landscape, about 20 lakh crore was what was put out as potential Capex. There could always be a difference between some of them committed this year but incurred in the following year, subject to that mismatch. About 20 lakh crore, and roughly about 7 lakh crore was centers program, about 7 lakh crore was states program, and about 7 lakhs crore was all the rest of the PSUs plus private sector, all of that put together. The center has moved all right, almost 35, 37% of the center's Capex allocation have been committed and projects have been awarded. The state has been little slow. They're about 20% now. I think many of the states are also dealing with their financial constraints, intercepted with election spends and social programs, etc. So the ability of the states to keep pace with the central program has been a little wanting. But we do hope that, as in the past years, the second half of the financial year, the states get to act a little more briskly. So we do hope that the state spend will pick up pace. As far as the PSUs and the private sector are concerned, I think PSUs are around 30% of their plan. And like states, PSUs are second half oriented. So we do expect the PSUs to come to party, so to speak, in the second half, more stronger than how they were in the first half. Private Capex has been a bit of a refreshing change. At half year level, normally our share of private Capex to total orders that we win, or you can even call it as private Capex as a percentage of the total order book that we have, normally is about anywhere between 15 and 20%. This year, September 22, when we reported and took stock of the mix, we are happy to see the private Capex at 37%. Of course, this has been largely helped by some large private sector orders, be it in the area of data center, be it in the area of steel plants, be it in the area of renewable energy. These large orders have, both in India and overseas, these orders have actually moved the needle up. I wouldn't want to read too much about point in time assessment of private sector at 37%. But the trend is that I think we would expect in the next, let's say, 12 to 24 months, the share of private sector to get much healthier than what they are today. The indications around industries such as minerals, metals, industries such as automobiles, industries such as data centers, industries around healthcare, these are all the IT and technology services. These are spends that we are seeing private sector coming to party. We also expect the airport spend to gather some pace as the Tier B, Tier C towns come up for development. Railway station development is again something that is being spoken about on private-public partnership basis. So if that were to actually play out, there could be some expenditure incurred on station developments, stations as transit-oriented developmental areas, and that could also see some private sector capex going up. So all in all, I think the next 2 years could be better times for private sector capex.
Yeah, Mr. Raman, we saw the Reserve Bank of India, revising its estimate for this financial year as far as the GDP is concerned. There is an optimism that in the first half the pace at which the capex has been undertaken by the central government has been lower, and you will see a big aggressive push happening in the second half of the year, which is from now to end of the financial year as more order books flow. Do you see that kind of activity on the ground, given you look at the tendering process very closely? Because if you look at the first half of the year, your award to tender ratio was very high, and when I look at your commentary, you've been very cautious in the commentary with respect to award to tendering in the second half of the year. So why is this thing, if we are going to see a big push of capex coming in the second half?
Okay, let me put some percentage to explain this point in proper perspective. The, there are three stages which are very important. One is project announcements per se. The second is the RFP issuance, and the third is the award. These are the three important stages. Normally, the RFPs that follow the project announcements operate around 50%. For example, if 100 is the value of projects announced, the RFPs that come out in meaningful time would be about half of that, about 50%. The award to RFP is an important metric. As of September FY22, the award to RFPs was almost 49%, and that's where possibly you are getting that sense that the award ratio has been high and brisk. It was 40% in September 21. So almost a 10% increase in September 22 is indicative of the fact that the government is pushing ahead with awarding on programs that they have decided to move forward and that they have got funding for. Now, normally these projects are bulky, and they have inherent difficulty in being boxed into a very specific time frame. Sometimes just the process of issuing the RFP could take it between one quarter to another quarter, or between Q4 of one year to Q1 of the following year, etc. Now, given that we have, as we speak, about 4.5, 5 months left for the current year, a lot of work needs to happen by January end, maybe mid-February, for us to see meaningful awards by March. So, given the time window and given the fact that the first half has been ahead of the curve in terms of the plan, I was possibly expecting that the second half may not be at the same rate of 50% of award to bid ratio. It could moderate to about 40-45%. But overall, for the year, it could still end at about 45%. So, and which is higher than the 40% of the previous year. So that gives us the optimism that the 12 to 15% growth in the order inflow that we have announced for the year, which itself is a very large number, because last year, if you recall, the fresh orders that we won was almost 1,92,000 crores. A 12 to 15% increase on that almost takes it to 2,15,000, 2,20,000 crores. And that's a tall ask. We are around 93, 94,000 crore mark in H1. So, which means we'll have to travel another 1,30,000 crores. But since our order inflow includes also orders from services business, etc., from the project businesses, we require about 1 lakh crore, project and manufacturing, 1 lakh crore in the next 6 months. Now, we have prospect pipeline of about 6 lakh crore. So, winning 1 out of 6 is a reasonable win rate. 15-16% has been traditionally our win rate, even on a conservative basis. In periods of time, we have gone up to 20%, but those are times where we had some unique advantage with respect to the projects that have been announced. But assuming on a very normalized basis, if we pursue 6 lakh crore between the state, center, PSUs, and private sector, between all of them, and between India and international. Winning 1 lakh crore seems to be a achievable goal, and that is what gives us the confidence that the 12 to 15% guidance that we have announced for the current year is something that is feasible.
From the revenue point of view, I think you're well ahead of your target because you there also you're 12 to 15%, and first half we've seen the revenues grow by 23%. But you're very reluctant to push your guidance on revenue beyond 15%, though the street is saying that L&T could at the same rate go past the 15% guidance which it has given. Why are you so reluctant in maintaining that very conservative band of 12 to 15%?
See, even today, the headwinds for execution is not completely non-existent. We do face on and off right of way issues. We do face resources constraints in terms of availability of the right skill manpower. Sometimes the equipments and the material that we have ordered out, particularly what we are importing into the country, is subjected to some timeline delays, etc. The clearances that we obtain from the various authorities are also not something that works in clock work precision. And there are these delays. Now, notwithstanding all this, we have tried to gamely move ahead in the first half of the year. We what we want to do is, while the potential to outperform exists, and I wouldn't deny that because we wouldn't want to slow down. Left to ourselves, I don't think we want to be constrained by 12 to 15% guidance. If we're able to overachieve on that, we'll be happy to do that. But our own experience working in public space, and most of our projects are in public space, we are subjected to public interest litigations. We are subjected to some restricted hours. For example, some of the projects that we are working in metropolitan areas, particularly in the area of underground metro and stuff like that, or even the coastal road project that we are working in Mumbai, etc. Now, these are subjected to restricted working hours because we are working in the heart of the city. So we're not given the entire 24 hours to do our work. Most of the clearance of debris, etc., happens only between 12 midnight and 4 a.m. in the morning. These restrictions also come into play. So, considering all of this, and the war is not yet over, we do not know whether it is escalating or whether it is de escalating. It is anybody's guess. So, given all of this, headwinds still existing and interest rates are going up, we do hope that the sponsors of the project that we are working on will continue to receive the funding at acceptable rates for them to proceed further with us. Also, the last 2 years, we have been very clinical in the sense that we have reduced our working capital intensity. We've brought down something like 26% to sales to about 20% now. The whole idea is that we don't want to put our balance sheet to complete the project and keep running behind the customers for recovering our dues. So we are trying to manage our cash flow within the collections that we do. So to that extent, if the client delays the payments or he extends the payment cycle, then the execution cycle gets delayed. Second half of the year, we hope that all the effects of increased interest rates, global recession, depreciating rupee, etc., does not make our clients change their program in a big way. Given these headwinds, we thought it is prudent to stay within the guideline for our own commitment to the market, deliver that. And if there is a possibility to delight the market by overachieving, I don't think we will hold ourselves back.
Okay, Mr. Raman, there are certain legacy assets and projects which you have. IDPL, there is a divestment. You want to sell it fully, but it hasn't been happening, and I think it's progressed. As per the commentary, where are we on that? And my second question is on the L&T Metro thing. You want to bring down the debt from 13,000 odd crores to 7,000 odd crores. How do you plan to do that?
Well, I think both are work in progress. The divestment of our toll road business, which is held in a subsidiary company, we actually co-own that asset along with Canadian Pension Fund. Both of us are in advanced conversation with a potential investor to complete the divestment. So to that extent, I do believe that in this fiscal, we will be able to complete the divestment. It is in two stages. One is we'll have to ink the commercial arrangement, and second is we have to get a whole host of clearances from various authorities like NHAI, various state governments, ministries of surface transport, etc. After all, we have close to 10 projects underlying. So those many sets of approvals are required. It's a bit of a risk to predict what exactly will be the timeline to get all of this done. We would like to initial the commercial arrangement as quickly as we can, and I think we are closest to that point than any time before. And thereafter, we'll have to go after the approvals. So I do think that all going well, we would like to complete the whole process in the current fiscal. But if some approvals get delayed, then it might just spill over to the first quarter of the next year. But from a direction point of view, I think that divestment will get completed. The power plant that we run in Chandigarh, Nabha Power Plant, it's a performing asset. In fact, the asset is performing very well. The Punjab state is using the capacity of the plant almost completely, running at 93-95% plant load factor. The coal supplies are quite consistent and regular. So the plant per se is not creating any stress for us, but it is a one-off asset, and we are not in the business of running power utility. So we would desire to exit that investment. But since it is not a stressed asset, it is a performing asset. We just want to make sure that we do it at a fair value rather than at any distressed value. At the moment, the offers that we had received indicates some element of distress sale, which we don't want to do. So we will wait our while. I think in a way, the energy crisis that is enveloping the world has some advantages, collateral advantages in terms of the investments in oil and gas sector picking up, as well as the thermal plant, particularly the coal-based performing power plants, getting better valuation. I think we would wait to get to those better times to do that. But ultimately, from a medium-term point of view, that is an asset we will divest as well. We will not but do it in any desperate manner. The third part is Hyderabad Metro that you touched on. I think the traffic is picking up, and we are quite happy about it. Last year, around this time, we were having traffic of 150,000 people per day traveling. Today, it is almost 450,000 people and counting. We do expect as IT companies get more and more people to office to complete their work, the traffic will pick up because Hyderabad is a fairly busy IT corridor, and Metro will be connecting. Metro has been connecting many of these IT hubs. So we do expect that 4.5 lakh will inch up to about 6 lakh passengers per day. While that happens, we also want to get our 13,000 crores of debt in the project down to about 8,000 crores. A combination of better ridership, fair revisions as and when they happen, as well as reduced debt, will improve the financial viability and attractiveness of the project. How do I want to get the debt down? I think government has sanctioned 3,000 crores of very long-term interest-free loan to the project in appreciation of what the project deserves. Now, that will reduce 3,000 crores of the debt. The only challenge there is it is not a single check from the government. It will be collected in installments. So as and when we start collecting the installments, we will start repaying the debt. We have also got the government's permission to monetize the land parcels that are associated with the metro project. And we do expect to get 2,000 crores out of various land parcels getting monetized. So the government grant plus the monetization of the land parcels should enable us to generate 5,000 crores, which will get the debt down from 13,000 crores to 8,000 crores. Now, this is the action plan that we are working on. I do think that it will take anywhere between 12 and 18 months for us to complete all of these things. Once we get here to this point, then the asset becomes attractive investment opportunity. We do think that investors will show interest at that point in time. And according to the concession agreement, we can come down from 100% to 51% to 26% in stages. So we'll at that point in time focus on getting 100% down to 51%. And thereafter, depending on further developments, we would like to get it down to 26%. Beyond 26%, the current concession agreement does not provide, but it is a 65-year concession. So there is enough, duration in the project for us to discuss with the government as to who the ideal owners can be for the back end of the project concession.
Sir, you also have a lot of exposure to the renewable energy sector. If I'm not wrong, roughly around $3 billion of order book coming in from solar and renewable energy.
Yeah.
Do you see this expanding at a faster rate compared to your other projects in infra book?
I think the world is paying a lot of attention to renewable energy, and within renewable energy, solar and offshore wind is getting a lot of traction. The climate change initiatives, etc., while it is talking about alternate fuel in form of hydrogen, etc., will take some time to settle down because at the moment the economics is not completely supportive. But we do expect solar to gather pace. It is just that cost of modules and the over dependence on China for supplies, which has been holding the program up. We think that if the solar modules were to become more affordable, given the fact that the solar energy has a certain preferred price point for being contracted out in the energy exchange, and the fact that it is not a peak load power supply medium, we do expect that price correction in solar modules will be an important component which will move the needle insofar as fresh investments are concerned. But having said that, markets like Saudi Arabia and generally Middle East, which is benefiting from the firm oil and gas prices, are investing even at today's module prices. So bulk of the orders that we have received from have been from Saudi Arabia. And in India, we are just doing a couple of projects in states like Gujarat, but the large chunk of our order backlog comes from Saudi Arabia. So we do think that countries which have the benefit of raw material prices, which are like oil or minerals, metals, and which are trying to get into energy intensive industries, will install solar capacities. And L&T being the largest player out of India, and we have all the pre-qualifications required to compete in the global market, we should be seeing more of solar orders. Whether they will outshine the rest of infra, which includes buildings, factories, the other forms of power transmission, distribution, water, heavy civil, defense infra, I do not know because it's too early to really put a relative size to it. But the interest of the sponsors in solar and offshore wind is pretty interesting.
So if I look at your new initiatives and new investments which you are incubating within L&T, uh, green hydrogen is something which you have done. I think you already commenced operations for internal use, and I think commercial. It will go commercial in this month or end of the month. How do you see that opportunity growing? And my question was that people are trying to get into this new segment, but you have kept this segment in house instead of being in a subsidiary. Why is that so?
Actually, the people who have put it out are people who want to play the entire value chain, meaning that they want to be operator of a utility which generates green power. We don't want to get into utility space. Our interest in green energy is confined to the EPC work that we can do for project sponsors and the equipments that we can manufacture for generating green energy. So our definition of this opportunity is essentially building the infrastructure, green infrastructure for other developers. We ourselves will not be a very large developer at this point in time. This is the focus that we're having. Given this, EPC is part of our core L&T's businesses, and green energy is only one form of EPC. So there was no occasion for us to actually put it out as a separate business or a separate entity. Secondly, we want to manufacture electrolyzers, and we have the manufacturing capacity and the capability in house. It is just getting the right technology to partner with us to be able to manufacture this. We do think electrolyzer is a global product, and we should be able to take care of both domestic requirements of electrolyzer as well as international requirements. Anybody who wants to generate hydrogen will have to go through the electrolyzer processes. So we do think that the demand will pick up as we move forward. Given this definition, we think both manufacturing and EPC being core part of L&T, this should be held within L&T so that the pre-qualifications for getting mandated, the chances are much higher. Many people do it for valuation. I don't think we are looking at it as a valuation game. We are looking at it as a sustainable avenue of promoting our own EPC business and manufacturing business.
What has been the experience in terms of cost of manufacturing green hydrogen for you? And a ballpark, because we are talking about cost coming down to as low as $1 or something. But since you have already done one and which is being used in house, how do you see that cost evolving?
What we have done in-house is essentially to tell ourselves that the prototype works before we commercially take it to the market. So the consideration was not cost economics as much as technology demonstration. The cost continues to be high. It is nowhere near $1 per kilo of hydrogen. We're still talking about $4, $3, $4 in that order of magnitude. But the scale that we have is very, very modest. It's not scaled up. So subscale facility will never be highly cost competitive. The scaling up will happen when the cost of technology comes down. I think the electrolyzer and power are two important cost components in the production of hydrogen. Both needs to come down. We do think that if not $1, at least if it moves to about $2 from the current $4, it could make investment worthwhile for people who want to get into this space. And like solar, I think the cost will come down. It's matter of possibly time and demand and the supply augmenting itself. So I think maybe in 2-3 years time from now, it could become more affordable than what it is today.
And you expect a joint venture partner coming in for electrolyzer, especially by the end of the fiscal?
Actually, we are targeting that. We are having discussion. There are a couple of technologies that are involved. We are in the process of evaluating what would serve us well. Because we can't keep switching technology when it comes to manufacturing. In EPC business, we can be technology agnostic. But when it comes to manufacturing a product, we need to be technology specific. So we do think we'll be able to zero in on that and then work on the commercials. Whether it takes the form of a joint venture where the technology partner owns equity, or is it going to question of buying the technology license or any other form of consideration, we'll have to follow once we select the technology. But all of this, we hope to come to some landing point by the end of this fiscal.
What about the storage battery facility? That's also one of the areas where you are setting up or you're looking at setting up this operations.
It's phase 2 actually. We are looking at static batteries and not mobile batteries. Meaning, it's not battery for cars and vehicles and stuff like that. It is more static. We have done some work for Government of India in the past, so we have some idea about how this works. But to bring it to commercial scale, I think we will do it as phase 2. We didn't want to bite too much ahead of time. We just want to get the electrolyzer and our own MOU that we have signed with IOCL. What we want to do is all the refineries, public sector refineries, have committed to putting up a green hydrogen generation plant facility. We've tied up with IOCL to be able to do that for them, along with Renew Power, because the power has to come from green source. And instead of putting up a renewable energy plant by ourselves, we have tied up with Renew Power. They will provide the green energy, solar energy, And we've tied up with IOCL, who wants to put up the facility, and we will be the EPC partner. So a three-way partnership has emerged in terms of MOU. How we take this forward and how this facility that IOCL puts up gets replicated in the other public sector refineries is what we might have to walk in the next 1 to 2 years' time.
You've put up 7,500 crores of capex plan in these three areas. You'll be able to fund them through your internal accruals, or you will look at some strategic partner to come in and bring some equity in these ventures, especially like electrolyzers and storage battery?
Actually, these are not L&T's capex per se. I think these are size of the opportunity. Now, depending on whether it's a capitalized joint venture or it is a partnership, etc., and based on the viability and economics, there will be a debt equity structure that will come into play. My own sense is L&T may not have to think more in terms of 3 to 4,000 crores of allocation over a period of next 2-3 years for this kind. Electrolyzer will be the first off the block, and that is not capital intensive at all. We have many of the manufacturing facilities already existing. So with about 1,500 crores, we should be up and running insofar as electrolyzer is concerned. As I told you, we're not going to install any generation for green power. We're going to buy the green power. So the concept that we are trying to work with IOCL, which will be a three-way partnership of take or pay facility, will possibly account for the rest of the allocation that you mentioned about. But there again, it's a three-way partnership, and there will be a debt equity structure depending on the strength of the PPA that we tend to execute with IOCL. So my sense is, I think maybe 5,000 crore out of the 7,500 crore is what we might have to think over a 2-3 year period of time. And if this really scales up, then it should be able to generate revenue to support the additional investments that might be required. At this point in time, other than the 2,000-3,000 crores of normal capex that we are planning, this could be another 3,000 to 5,000 crores.
Thank you, Mr. Shankar Raman, today for joining us on BQ Prime. It was a pleasure talking to you. Thank you for watching BQ Prime. Thank you.
Thank you.